Grindrod Asset Management and Plexus Asset Management have announced a merger between their respective asset management businesses. To talk more about this, we're joined from our Cape Town studios by Paul Stewart, Executive Director from Plexus. Thanks so much for joining us, Paul. First of all, it's obviously a big day in the life of both Plexus and Grindrod Asset Management. This merger has been a long time in the making. Can you just take us through the rationale for the deal?
Sure, Bronwyn, good evening. Mergers happen for a variety of reasons, and in our case, it really was much more evolutionary than revolutionary. We met the Grindrod folks way back in 2009 on a completely different guise, and gradually got to know them over time. We recognized that they had parts of a business which we looked after and sought after, and particularly in the area of distribution. They're very strong in the area of listed property, preference shares, sort of the income assets. We, on the other hand, had an expertise in the area of sort of asset allocation. We own the RAFI Fundamental Index, the enhanced methodology in South Africa, and we also distribute the PIMCO funds in the country. And so, as we started talking to each other, we recognized that there was a lot of room and a lot of synergy between these two businesses, them being perhaps more retail focused and us being slightly more institutional focused. And we just got to the point, as I said, on an evolutionary basis, where it actually made an enormous amount of sense to have a look at putting these two businesses together. And we've been working hard on that over the last couple of months, and finally arrived at the date when that's actually happened now.
Paul, both elements will bring around 4 billion rand in assets to the table, so the merged entity to have about 8.5 billion rand in assets under management. Why the decision to call it Grindrod Asset Management and lose the Plexus brand on this one?
I think and I obviously don't want to speak too much on behalf of the Grindrod Group here per se, but in terms of the discussions we've had with them over the last couple of years, they very much took a strategic view at the Grindrod board level to invest in the financial services business. They've already got the bank, as you well know, and their private client business has actually been going for a fairly long time, and that's where they had the expertise. And so they decided that they wanted to invest in this business and grow it over time. And I guess, from a Plexus point of view, we were at the stage in our lives where we needed a change in our business. We had sort of reached the ceiling of what we could achieve on our own, and I guess ultimately you can only have one brand. And I think we on the combined basis, we felt that the Grindrod brand was the broader brand in the marketplace. They are the ones that are actually wanting to aggressively grow this part of the business.
David wants to jump.
I find that odd because will remain behind.
David wants to jump in with a question here.
Paul, I find that rather odd because I like Grindrod. I think they bring in some very good products. I particularly like the new one, the preference share product that they're bringing in. It just eases things for us. But on the other hand, Plexus has been almost synonymous with the unit trust industry today. You give all the awards every year, you're seen there, and people aspire to be recognized by you. So I find that a bit odd. I think that maybe you're understating your position in the market. Sure.
I mean, we recognize that our brand has equity, obviously, and but ultimately you can only go with one brand, and since Grindrod will be, in terms of the shareholding of this new entity, they will be the senior partners. It did make sense for them to actually want to grow their own brand, and I think in 5 years' time we'll look back and we'll recognise that it's the right decision. The Grindrod brand is a growing one. They've got a national distribution footprint in the retail market. They've got offices all over the country, whereas Plexus is very much a regional Western Cape-based business. So certainly not doing ourselves down. We've worked very hard at building our brand. But ultimately, one has to go with a brand and a committed brand, or committed to one of the brands, and we're happy to commit to the Grindrod brand and help build that the way we built the Plexus brand over the last number of years.
Well, Paul, we certainly wish you all the best of luck with the venture going forward. Now, moving to your views on the market, sir. Earlier, we had Viv Govender relatively unsettled by the negative news flow we're seeing of late, particularly that jobs data out of the US on Friday. David Shapiro still smiling solidly in studio. He's convinced that that is just a blip in the world economic environment. What are your thoughts right now? Is the worst behind us? Let me put it that way.
Bronwyn, you know, I think when I was on the show last time, you know, we said that, you know, ultimately governments and economies have to make decisions, and we think those decisions are going to be to support economies and to make things right over time. And so, you know, I would probably be more in David's camp on this one. You know, we're going to have volatility, you know, until Italy and Spain and the rest of Europe is sorted out. It's going to keep on coming back, and it's going to keep on reminding us that there's problems there. But ultimately, we think that the powers that be will make the necessary decisions and will do the right things, and therefore, you know, we think that one has to be more positive than negative right now. I think the key thing is to understand that if you have a certain view of the world, and that view of the world is that ultimately, you know, the governments are going to print their economies and inflate their way out of trouble, then you have to own real assets. You have to own, you know, the commodities. You have to own, you know, property. You have to own precious metals, because those are the assets that will probably retain their value best in times like this. And obviously, high quality equity names too.
It's very interesting what you say, because earlier on in the show, the point I was making that we don't see selling pressure. We don't see a lot of people phoning us up to get out the market. And to me, that gives me some kind of comfort. So the question I'll ask you is that you do run a lot of funds. You know, in these bad times, do you see a lot of money coming out of the funds, or do you still see inflows coming in?
No, I mean, our sort of burn rates of assets are pretty stable over time. You know, sort of 6 to 7% per annum of people taking money out to, you know, fund other things, you know, annuities and those types of things. So we haven't. I think we would agree with you. We haven't seen any significant outflows from the funds that you saw in the late part of 2008 and early 2009. And so, you know, I think people have perhaps become accustomed to the negativity in the market. I think also the industry has done a better job in you know, reminding people that they need to take a slightly longer term view on this, and so people are heeding that message these days perhaps more than they would have in previous crises.
Yeah, because I tested Viv as well, and the asset testers, whenever we hear these bearish comments, will say, well, are you going short? You know, are you selling your assets? And everybody says, no, I'm not getting out the market, I'm holding on. To me, that's a very positive sign. So I'm very pleased, you know, to hear what you are saying about, you know, direct
Indeed, David, and you know, I think the other point, of course, is, you know, one should never hold assets, you know, simply because they're cheap on a relative basis. But you know, if you look at, it doesn't look likely that cash yields are going to be rising anytime soon. There's not massive upward pressure on bond yields. So, you know, but if there is a risk, it's perhaps slightly to the upside, where you could have a small capital loss from listed properties. So, you know, the more risky asset classes are really, you know, I think you're getting paid relatively well to assume that risk at this stage, but notwithstanding the fact that there are, you know, downside risks, and one can't ignore those. But you know, relative to where else you can earn a decent return, above inflation return, you have to look at the more risky asset classes.